Good evening, everyone. We'll start with Unit 3 of Financial Risk Management. Uh, Unit 3 of Financial Risk Management, uh, Banking Specialization, 4th semester, Master of Business Administration, University exams. Unit 3 says options, stocks, and currencies. There are five things which have been mentioned in the unit, that is, mechanics of options market, trading strategies, Black-Scholes model, options on stock indices, and currencies. We'll study mechanics of options trading, options market in a different PPT altogether. Let's go through the unit as a whole. Options we've already discussed in second unit elaborately about options. Options are the financial instruments that are derivatives based on the value of underlying securities such as stocks. An options contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold, the underlying asset. The option to buy is called call option and the option to sell is called put option. We have already discussed this in second unit, so I would recommend if someone's having doubt anything about options, then he or she should visit unit 2 video to understand about options. We have already gone through this flow chart as well. Derivatives are futures and options are call option and put option. Call option is the option to buy and put option is the option to sell. Mechanics of options and trading strategies we'll discuss in another presentation, altogether different presentation for options and trading strategies. Let us go and understand what about Black-Scholes model is. Black-Scholes model is a pricing model used to determine the fair price or the theoretical value for the call or a put option based on the six variables. There are six variables such as volatility, types of option, underlying stock price, time, strike price, and risk-free rate. Black-Scholes model makes certain assumptions. So what are the assumptions of Black-Scholes model? It says that the option is European and can only be exercised at expiration. So you cannot you cannot exercise your option before expiry date like you do in American option. The option is European. No dividends are paid out during the life of the option. Markets are efficient, that is, market movement cannot be predicted. There are no transaction costs in buying the options. The risk-free rate and volatility of the underlying are known and constant, and the returns on the underlying are normally distributed. So they are not skewed, they are normally distributed. While the original Black-Scholes model did not consider the effect of dividends paid during the life of the option, the model is frequently adapted to account for dividends by determining the ex-dividend date value of the underlying stock. Now, the model assumes the price of the heavily traded assets follow a geometric Brownian motion with constant drift and volatility. When applied to a stock option, the model incorporates the constant price variation of the stock, the time value of the money, the option's strike price, and the time to the option's expiry. So, according to this model, the price of heavily traded assets follow a geometric Brownian motion with Brownian motion is random motion with constant drift and volatility. When applied to the stock options, the model incorporates the constant price variation of the stock, the time value of money, the option's strike price, and the time of the option's expiry. Also called Black-Scholes Merton, it was first widely used model for options pricing. It's used to calculate the theoretical value of options using current stock prices, expected dividends, the options strike price, expected interest rates, time of expiration, and expected volatility. Now, here comes the Black-Scholes model. For call option C, C is equal to, that is, the value of the call option is Sn into D1 minus Xe power minus RT N D2. If you look into the right hand part, you will find out the call option at strike price and time t is strike price into n into d1 minus ke power r into t minus t into n d2. Let us understand what this is. Here, when I talk about this, here we come to know that the options price is S, means it's a strike price or stock price, and ND1 is the probability function. So return, this represents S, not N, into D1 represents return, that is stock price into probability function. And cost minus cost means strike price into discount to present value. So this is continuous discounting what we are doing. And then probability function, that is ND2. And how you calculate D1 and D2, it is mentioned here. D1 is log of S by X plus R plus sigma square divided by 2 into T divided by sigma under root T. This is S is stock price, X is a strike price of option, R is risk-free interest rate, T is time to expiration in years, so how many years are left for the expiration, sigma is the volatility, and N is a cumulative normal distribution function. D2 is D1 minus a sigma under root T. Again, sigma here is volatility and T is a time to expiration in years. And similarly, if you look into put option, it's P into XE minus RT. It is just opposite to what we have in the call option. Here we have XE minus RT power RT n minus D2 and minus SN minus D1. So it is just opposite to what we have in call option. This is Black-Scholes model. You will have to remember this, that return is a stock price into probability function and cost is a strike price into discount to present value into probability function. And when we try to find out the return, it is stock price into ND1, and cost, when we try to find out, it is stock price into discount to present value into probability function, that is KE minus KE ki power minus R into T minus T and ND2. So this is there. Now options on stock indices. Stock index option provides the right to trade a specific stock index at a specified price by a specified expiration date. A call option on the stock index, call option and a stock index gives you the right to buy the index, and put option on the stock index gives you the right to sell the index. An index option is a financial derivative that gives the holder the right but not the obligation to buy or sell the value of an underlying asset, such as Standard & Poor's 500, at the stated exercise price on or before the expiration date of the option. No actual stocks are bought or sold. Index options are always cash settled and are typically European style options. Let us understand what are European style options and what are American style options. American style options are the options when you can exercise your option any time within the time limit. For example, the options to expire in 2 years. So any time of the option you can exercise your option and get that call option. But in European, you cannot exercise your option before the expiry date. So you have to exercise your option. You can exercise your option only on the expiry date. Now, features of stock indices are spread. Spread means a spread of risk, spread of the funds into various indices, because it is related to indices. Indices means Sensex, Nifty, these are indices, and spread means it is properly spread to the various stocks in that indices. Leverage is related to risk, so definitely it has, because it is equity related to equity, that's why it will always have leverage. Linkage, it will always have linkage to the stocks. High risk and diversity of the risk, so there will be high risk and there will be varied diversity of the risk because it is related to indices, so it will vary according to the price of the stock indices. Now let us understand currencies. Currency is a medium of exchange for goods and services. In short, it's money in the form of paper or coin, usually issued by a government and generally accepted at its face value as a method of payment. Currency derivatives are financial contracts between the buyer and the seller involving the exchange of two currencies in the future date and at a stipulated rate. Currency derivatives Trading is suitable for those interested in reducing their foreign exchange rate risk. NSE has product futures and options August 2008. It was launched in October 2010. Here we are talking about exchange-based currency derivatives in India. MCX has futures, which was launched in October 2008, and USE has futures and options launched in September 2010 and October 2010 respectively. I've already discussed about currency derivatives and exchange of foreign currencies in Unit 1. So if you have any doubt, definitely you can visit that part. Now, what are the features of currency options contract? They are standardized exchange traded currency options have the following features. The underlying for the currency option shall be US dollar. Indian rupee spot rate means US dollar Indian spot rate will be the underlying, will be the basis of currency options. The options shall be premium styled European call and put options. The size of each contract shall be US dollar 1000. The premium shall be quoted in rupee terms. The outstanding position shall be in US dollars. The maturity of the contract shall not exceed 12 months. The contract shall be settled in cash in Indian rupees. Settlement of price shall be the Reserve Bank's reference rate on the date of expiry of the contracts. So these are the features of currency options contract. With this, we come to end of the third unit. I hope you all enjoyed the session. In case you have doubt, please send me in comment section. Thank you.